Hello and welcome back to the channel, Financial Navigators. Today, we're diving deep into a fascinating microcap stock that has ignited our hard-to-borrow screener with some truly eye-watering numbers. We're talking about NCT Cayman Limited, trading under the ticker NCT. If you're curious about what makes a stock incredibly expensive to short, and how that can sometimes lead to explosive price action, you're in the right place. Let's break down an NCT unique situation. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show NCT ticker and company logo/info. NCT, or NCT Cayman Limited, operates in the industrial sector, specifically within marine shipping. Through its subsidiaries, it provides crucial maritime shipping services in Hong Kong and internationally, offering time charter and vessel management services globally. Interestingly, they also dabble in the processing of pulp paper and paperboard products. This is a microcap company, meaning it often exhibits high volatility and unique market dynamics. Looking at recent price action, NCT has been relatively stable, showing a slight dip of 0.59%. However, over the last 5 days, it's up plus 1.20%, and over the last 30 days, it's seen a respectable gain of plus 8.68%. Show price chart. Today's volume has been significant, with 1,337,486 shares traded, which is a whopping 2.5 times its 30-day average volume of 533,566 shares. This increased attention is a key signal. What is cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow, and why should you care? Show animation of short selling. When you short a stock, you're essentially borrowing shares to sell them, hoping to buy them back later at a lower price and profit from the difference. But those borrowed shares aren't free. There's a fee, called the cost to borrow, or CTB. This fee is paid by the short seller to the lender of the shares, usually a prime broker. The CTB is typically expressed as an annualized percentage. So, if a stock has a 100% annualized CTB, a short seller is paying 100% of the value of the shares they borrowed per year just to hold their short position. This fee matters immensely because it's a direct expense that eats into a short seller's potential profits. The higher the CTB, the more pressure there is on short sellers to either be right very quickly or cover their positions to start the bleeding. Why this stock is hard to borrow right now. Now, let's talk about NCT and why it's appearing on our hard to borrow screen. The cost to borrow fee for NCT right now is an astounding 677.5% annualized. Highlight 677.5%, that's not a typo. Imagine paying nearly 700% of the value of your short position every single year just to maintain it. This sky-high fee signals extreme demand to short NCT shares coupled with an incredibly scarce supply of shares available to lend. A major factor contributing to this is NCT's incredibly tiny estimated float, just 0.3 million shares. Highlight 0.3 M float. When there are so few shares available for trading in the open market and even fewer available to borrow for short selling, any significant short interest quickly drives up the cost to borrow. Today's elevated volume, 2.5x the average, suggests increased interest, potentially from both sides, longs buying and shorts trying to establish or maintain positions in a very tight market. Squeeze mechanics explained. This brings us to the concept of a short squeeze. Show graphic of squeeze mechanics. When a stock is hard to borrow and the CTB is this high, it creates significant pressure on short sellers. If the stock price starts to rise, short sellers face a double whammy. Their position is losing money, and their borrow fees are astronomical. This can force them to buy back shares to close their short positions. When many short sellers are forced to cover simultaneously, it creates a wave of buying demand. In a stock like NCT, with its minuscule 0.3 million share float, even a moderate amount of forced covering can have an outsized impact on price. This rapid buying pressure, driven by short covering, is what we call a short squeeze. It's important to remember, though, that high cost to borrow does not guarantee a squeeze. It can also mean that short sellers have very strong conviction that the stock will eventually decline, and they are willing to pay a premium to maintain their positions. Our internal composite squeeze score for NCT currently sits at 42.5 out of 100, reflecting the significant CTB but acknowledging other factors are at play. Dilution risk check. One crucial factor to consider when evaluating a short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, effectively increasing the total number of shares outstanding. Show graphic of dilution. If a company with a high CTB issues a large number of new shares, it can flood the market, making it easier for short sellers to cover their positions without driving up the price. More importantly, it could fundamentally change the supply-demand dynamics, negating any potential squeeze. For NCT, we've run our checks and found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days. We also found no recent reverse splits for NCT in our look-back window. This is a positive sign for any short squeeze thesis, as it removes a major potential headwind. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For NCT, with its current setup, here's what astute traders will be watching. First and foremost, continue to monitor that incredible 677.5% annualized cost to borrow. Any sustained decrease could signal lessening short interest or increased share availability. We currently don't have data on the exact number of shares available to borrow, but this is a critical metric to track if you have access to it. Secondly, keep an eye on the volume. NCT 2.5x relative volume to date is notable. Will this increased interest continue? Persistent high volume on upward price movement, especially with that tiny 0.3 million share float, could signal increasing buying pressure. Lastly, watch the price action. While NCT was down slightly today at 0.59%, its monthly performance of plus 8.68% shows it can move. Any significant breakout could start to squeeze out those shorts paying such exorbitant fees. Intercon Cayman Limited, NCT, presents a fascinating case study in the world of hard-to-borrow stocks, driven by an extreme 677.5% CTV and a very limited 0.3 million share float. While these conditions create the potential for a short squeeze, always remember that risk is inherent, and high borrow fees alone do not guarantee a specific outcome. Short sellers are paying these fees for a reason, often with strong convictions. Do your homework, understand the risks, and keep your strategy sound. If you found this deep dive into NCT helpful, please hit that like button, subscribe for more unique stock breakdowns, and let us know in the comments what other hard-to-borrow stocks you're watching. We love hearing from you. Thanks for watching, and we'll see you in the next video.